I learned very early on, if you have good reason to expect something to happen that nobody else expects, the odds are high that you'll do very well with that bet if you're right. We still, and I get this metric every day, we still expect north of 20% compound annual returns from our portfolio over 5 years.
Hey, I'm Stephen and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, I'm reacting to some clips of Ark Invest Cathie Wood, who recently spoke to Ben Singer, as always, link in description to the full interview, explaining what Ark Invest does during a market sell-off or crash, what makes Ark Invest different from other investors, how investors can spot and identify opportunities in disruptive, innovative companies and technologies, why investing in benchmark indexes like the S&P 500 is a terrible idea, short-term versus long-term thinking in terms of investment, and Tesla's 4 barriers to entry. So let's get into the video. But first, hey guys, if you'd like to help out the channel and get up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it.
Tesla was at like 240, went to 170 or 178. You were out that day, so you didn't buy at 178, but you kept buying Tesla all the way down. Your conviction, didn't go away and you just kept going, right?
No, we were looking at their 4 barriers to entry, and our conviction in those were growing. They were all technology oriented, the battery, the AI chip, the miles driven, the over-the-air software updates to performance. We did not think the company was going to run out of money. The markets were open. This was not 2008, 2009, and that was the reason it was imploding. It just seemed like a silly reason to us. I learned very early on, if you have good reason to expect something to happen that nobody else expects, the odds are high that you'll do very well with that bet if you're right.
Cathie Wood singing my song. This seems to be the story of my own investment career, which only spans a little over a decade, but thus far my experience generally has been, I find an opportunity, I dig really deep, I go, oh yeah, nothing there. Find another opportunity, dig deep, nothing there. Find another one, dig deep, oh, there's something here. Notice this opportunity, identify a huge potential, and then everyone around me thinks I'm completely insane, tells me I shouldn't do it, it's risky, I'm going to lose all my money, how do I know, blah, 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 blah. I now have enough conviction and confidence in my own decision-making process that I do not care what anyone else has to say about anything that I'm doing with my money. I back myself, I back my decisions, and so far the track record has panned out. Now the point Cathie is making here is if you can identify these opportunities, don't just take a cursory glance and look at some and go, oh yeah, really dig until you can build up that level of conviction or realize, okay, there's not really anything here, I'll move on to the next thing. Once you dig deep enough and build up that level of conviction, if the market thinks you're wrong, if the consensus thinks you're wrong, but you're not, this is where you can make those huge, phenomenal, outsized investment returns. Because while the market's thinking one thing and you've identified the opportunity, if you are right, if things play out the way that you expect them, for example, Tesla stock, as I've mentioned many times on this channel, despite the fact that the company's revenue was growing, the technological lead was growing, their software prowess was growing, their manufacturing expertise was growing, blah, 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 blah. Despite all of this, from about 2014 to 2019, Tesla stock traded sideways. There were literally periods in 2019 where you could buy Tesla stock for about 25% less than it was at periods in 2014. So literally nothing happens to the stock price, less than nothing. It goes down over the 5-year period. Yet their revenue's going up, their sales going up. Like this is like, guys, everyone's going to be using EVs in the future. Tesla has a huge lead. What are you guys doing? Huge opportunity. Hence all in on Tesla stock, and hence we now know that that worked out okay. The point Cathie is making here is these are the kind of opportunities. When the consensus is dragging the value of a stock down because they don't believe in the company, the technology, etc., they can't see the inevitable disruption. This is where you find those outsized investment opportunities and those 10x, those 100x returns.
We were buying Amazon. It was $5 billion in market cap. I think it's up to 1.7 trillion now. So this was 2002. And I had to announce my trades every Monday morning. I announced Amazon, and you could have heard a pin drop. Like, what? At that time, The internet was considered a figment of Wall Street's imagination. So many people had gotten hurt. Amazon, I think, was down 80% from more than 80% from its peak. And no portfolio manager or analyst wanted to admit ever having held or recommended an internet stock. But we were convinced. I had 3 little kids at the time. I had no time to shop. I did all of my shopping on Amazon. Did I get everything? No, there were all kinds of problems with it. But I was delighted because I didn't have to go to the store. And I just knew online was going to become a big deal.
Well, unlike Cathie Wood, around 20 years ago, I didn't have 3 young kids. In fact, I was a teenager myself. But I did make my first Amazon order. Shout out to my dad, who was very internet savvy, network administrator, was really aware of the opportunities and realized there's no point buying expensive shit in Australia if you can import it from the United States and pay half the price after shipping, which was the case for many products on Amazon.com at the time. So I personally have been importing stuff from Amazon for over 2 decades, give or take. My old man's been doing the same. It just made sense. Bigger selection, cheaper prices. I mean, what more do you want? It became very obvious to me that Amazon was going to become a dominant company. Even as a teenager, using the service myself because of the convenience, I realized over time, they're going to crush everyone. Those of you who've been following the stock will know I owned Amazon for a number of years, recently sold to buy more Tesla in this current crash/dip, so no longer an owner of Amazon stock, but I really think that company is just going to continue to scale over time. It took a lot of people a long time to realize the opportunity there. It's difficult for me to understand how you miss this when you realize the value to the customer, the utility, the convenience, the cost saving, the selection. Like, hello, how does anyone compete with this? And the answer is you don't, and we're seeing that play out now. Sometimes people miss these opportunities. They get blinded. They look at Amazon like, wait a minute, the revenue keeps going, but they're not making any more profits. Must be a bad business, huh? Because these kind of folks don't really think very deeply and go, hang on a minute. Wait, what if Amazon raised their prices by 1% on every single product across the store in the future? What does that do to their revenue and their profitability? Holy shit. So a lot of people miss this. They didn't think too deeply. But these kind of trends you cannot fight. The same thing with digitization of music, etc. When was the last time you went to the store and bought a Blu-ray or a CD of your favorite movie instead of just streaming on demand? Why would you do that when you can just subscribe to Netflix or whatever, get your video on demand? You don't have to store it, keep it, clean it, find it, none of that stuff. It's more convenient, it's cheaper, everybody wins. There's less bottlenecks, less headaches. It's a more seamless experience for the user. There's lower overhead because there's no packaging, shipping, etc. It just makes sense. Some people identify these opportunities and these trends. Others, they just kind of miss them until it's already happened. I think we're seeing the same thing play out now with artificial intelligence, deep learning, genomics, robotics, automation, full self-driving vehicles, these kind of things. A lot of investors seem unwilling, unable, or incapable of truly grasping the implications of disruptive innovation and the exponential growth of technology. But this is great for me. Provides me amazing buying opportunities. Sometimes it might take a few years before the market finally gets it. Other times it could take more than a decade. So in the meantime, I'm happy to be buying companies like Tesla at a massive discount, knowing with a high level of conviction that in the future, they'll have autonomous robotaxis on roads, they'll be moving energy around with their software. Some people just cannot see it. I feel like Tesla today is close to Amazon 20 years ago. Some people believe in the company, some people understand there's some potential there, but still, overall, in my opinion, the markets just do not understand what Tesla is going to do.
And yet the psychology of the moment was so thick. Understandably, there were a lot of risk control experts, guiding portfolio teams saying, this internet thing, no earnings, you got to have the earnings. As you know, Tesla wasn't going to have earnings for another, I think, 10 years. So yes, going against the grain. In fact, sometimes when the sentiment is so negative and we have good reason to believe that something differentiated is going to happen, unexpected. Those are great times. I call them the valley of death. It's a saddled S-curve. The first saddle S-curve, it's kind of a fake out, too much money chasing too few opportunities too soon. That was the internet, late 90s. Then in the mid-2000s, early to mid-2000s, valley of despair. Nobody wanted anything to do with these stocks. And then that's a great time to pick up stocks. And right now, 3D printing stocks have been there for a long time. And then you enter the sweet spot of the S-curve, and it's unstoppable. It's much less risky than we believe the benchmarks are. The benchmarks are filling up with value traps because the innovation platforms, there are 5 of them, and they involve 14 different technologies that are all taking off right now. They are going to disrupt and disintermediate the traditional world order. So I think the big risk is in the benchmarks, not what we're doing.
A lot of investors seem either unable or unwilling to accept the enormous risk that today comes with index-style, benchmark-style investing, such as owning the S&P 500 index. I can sum this up fairly simply. Let's not overthink this here. The term disruption probably tells you everything you need to know. If the majority of companies today currently in the S&P 500 index tomorrow in the future get disrupted by another company, what does that actually mean? It means they're out of business, they're bankrupt, or they're a shadow of their former selves. So why would you want to own an index that contains hundreds of companies that are literally going to be displaced and disrupted by better, more innovative companies and technologies? I mean, it's insane. Wouldn't you rather just focus on the disruptive, innovative companies and technologies themselves? I know this is going to be hard for many investors to accept because the idea of index funds, generally speaking, over time, consistent, low risk returns, great diversification. But I'm telling you guys now, this is not going to be a successful strategy in the future. You cannot fight disruption. You cannot find exponential growth. You cannot fight change. And we are going to see seismic transformations across the board. There's going to be a huge amount of carnage. So many companies going out of business, going bankrupt, merging, being acquired. It's going to be brutal. Let's just leave it at that. The stock market is going to be completely upended and turned on its head over the next 10 plus years.
Disruptive innovation is priced incorrectly. Why do you say that, and how do you see it?
It's priced incorrectly in the public equity markets because of the short-term investment time horizon of most strategies. So if you talk to most analysts and portfolio managers, they're really focused on the next year or 18 months in terms of guiding their buy and sell decisions.
I've never really understood the short-sighted nature and near-term focus of most Wall Street analysts. I really genuinely find it difficult to understand why you'd be thinking in quarters and years rather than decade-plus periods. I do kind of understand it. People want to get their quarterly performance. They want to get their bonus every year, blah, 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 blah. But how do you identify these generational companies that are going to literally transform every aspect of an entire industry over a 10 to 20 year horizon when you're looking at what's happening next quarter or next year instead of next decade? Many of you guys will have heard me say 4 trillion times at least on this channel. I don't intend on selling any of my Tesla shares anytime before 2030. That doesn't mean I'll start selling them on January 1st, 2030 either. It just means that I'm not considering selling a share before then. That will mean that I've held my Tesla shares for at least a decade and a half before I even think about selling any. Same can be said for the real estate I began purchasing in 2010, 13, 14, 15, blah, 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 blah. Haven't sold any of that either. Never intended on selling that within a few years. In fact, always intended on holding my real estate for at least 30 plus years. So my time horizon as an investor is a multi-decade. That's where you can really get that outsized growth and benefit enormously from compounding. So to me, when I see Wall Street analysts releasing like a price target on Tesla stock and they haven't modeled out deliveries to 2030, I'm like, wow, you're an actual moron. No point even paying attention to your research. Get the fuck out of here.
We are not. And in fact, we want our companies to sacrifice short-term profits in order to be in the pole position to win in many of these winner-take-most markets. Artificial intelligence is causing a lot of winner-take-most markets. The companies with the best data, the highest quality data, are going to win. Tesla in the autonomous taxi network world is one of those examples.
Shout out to the intellectually challenged Wall Street analysts, the deluded Tesla bears, and the deranged basement-dwelling adult virgin Tesla short sellers who over the past few years have said things along the lines of Tesla can't make a profit, Tesla's going to go bankrupt, Tesla will never be profitable, who were incapable of doing this very fundamental analysis of the company and looking forward more than 1 or 2 quarters into the future and understanding that Tesla could make a profit if they weren't reinvesting aggressively in growth and scale, which is what they've been doing. Now, I really want to take a moment to let this point sink in. Practically everyone who doubted Tesla's viability as a company got stuck in this short-sighted mindset. Oh, they're not making a profit today, therefore they're losing money. I don't need to think about this anymore. I don't need to dig any deeper. I don't need to ask the questions. Why would they be reinvesting so heavily in R&D and expanding production capacity and new products? Why would they be doing this? Is it possible they're investing for future growth? I don't even need to think about that because right now they're not making a profit on paper this quarter, therefore it's a terrible company and you should short Tesla. So the next time you hear somebody talking about Tesla and they say something along the lines of Tesla can't make a profit, they need regulatory credits, they're dependent on ZEV credits, something along those lines, you are now fully aware that the person you are speaking to has just volunteered the fact that they're either a potato, a donkey, or a muppet, and their opinion is probably worth about as much as their own personal stock portfolio would be if they were investing based on their own analysis.
By definition, then, if our companies are investing aggressively now for going short-term profits, their valuations are going to look very rich. And that's probably the biggest criticism we get. It's on today's valuation, next year's valuation. If you give us 5 years, however, and given the exponential growth rates we're talking about, say 82% growth on average per year in the electric vehicle market, if you give us that, we are managing value portfolios. I truly believe that. Now, a year ago, I would have told you deep value portfolios. But of course, the market has recognized Tesla and many of our genomic stocks and many of our innovation themes, period. But we still, and I get this metric every day, we still expect north of 20% compound annual returns from our portfolio over 5 years. So that's more than a doubling. In a sell-off, any sell-off, we will concentrate towards our highest conviction names.
Did somebody say concentrating on your highest conviction names during a market sell-off, crash, or downturn? Singing my song once again, Cathie, to give you guys an update. Regular viewers of the channel may already know this, but for those of you who don't, I recently sold out of positions including Google, Amazon, Ark Genomics ETF, and CRISPR because I thought, you know what, this is an enormous buying opportunity for Tesla stock. I had plenty of conviction in those other names, but as Cathie Wood herself suggests, during these times, there's stuff on sale, there's bargains out in the marketplace. It makes sense to concentrate into those highest conviction names. For me, Tesla, my number one conviction stock, has been for a number of years, still is today, and literally a man of my word, the same type of action that Cathie Wood and Ark Invest are taking with their portfolios, their ETFs, I've been doing with my personal investments. I'm now down to one stock, literally all in on Tesla stock, rather than 97, 98%, which has been the case for about the last half decade. I'm literally all in on Tesla because it was on sale. I even sold some of my stocks at losses to buy more Tesla stock. That is a level of conviction I have. Glad to see Cathie and I are on the same page.
So during the coronavirus, for example, the crisis, we went down to 33 names in our flagship portfolio. Today, we're up to 55. So what we will do in an extended correction is we will concentrate the portfolio once again to the top 30, 35 stocks, because those are the ones in which we have the highest conviction. And it has been that conviction has been growing over time. I think our performance has attracted a lot of attention. I think the fact that we're willing to share our research and be that vulnerable out there. If you think about it, we put our Tesla model on GitHub, and this was around the time of the controversy. Oh my gosh, the blowback we got from that, because there were errors in our model. Guess what? There are errors in every buy-side company model. I guarantee it. We are going to have fewer errors because of all of the kind people out there giving us constructive criticism, saying, hey, we think you got this wrong, or this doesn't add up, or did you link with this?
So first of all, I have to commend Cathie Wood. I mean, she has pretty big balls, which is kind of impressive for a woman, at least. I think she's a woman. I mean, it's 2021, so anyone can be anything, right? Anyway, moving along, the point that I'm making here, the fact that Ark Invest is so completely transparent, not only sharing every single stock they bought and sold during the day at the end of the trading day, every single day, complete transparency to all their buying and selling activity in the stock market. But Ark Invest is also willing to publicize their own valuation models, for example, on Tesla. The fact that they do this is actually a great way to solicit feedback and improve their models even further. And I think that this model over time is going to become the gold standard for investment firms, Wall Street analysts, everybody who wants to have the best quality data and information and the best insights into where companies are headed in the future. There's no point working in a silo. The fact that we have the internet now, we have these tools to communicate, collaborate, to provide feedback, etc. It is a goldmine, and you'd have to be an absolute moron not to take advantage of this. After all, it was the online forums, the folks on Twitter and the YouTubers who actually understood Tesla before Wall Street. Why? Because of this interaction, the collaboration, the comments, everything. By the way, guys, you may have noticed that I say that I read all of the comments on my YouTube channel. I still do. I wouldn't be saying that if I didn't. It provides great insight, not only into the psychology and the mindset and the collective actions and thoughts of many investors out there, but sometimes people will catch me. I've made an assumption here or there. They can correct me. They can share a new insight. Hey, did you think of this? Did you think of that? Etc., etc., etc. This open platform, this way of sharing ideas, soliciting feedback, having this kind of feedback loop where you put an idea out there, you get some feedback, blah, 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 this iterative process. It's just brilliant.
So I think our models probably are the most robust in the buy-side world because we're willing to put our models out there, certainly the most controversial ones, because we want to educate investors. Like, this is a really important stock and you have an opportunity here. Don't even buy into Ark. Just take a look at this model and buy the stock for yourself if that's how you like to do things.
So I hope you guys have enjoyed this video. Let me know in the comments below, what have you been doing during this stock market downturn? Have you been concentrating into your highest conviction stocks, much like Cathie Wood of Ark Invest and myself have been doing? Have you been panic selling stocks for a loss because you're an idiot and you'd like me to make a video laughing about you in a few months' time? Have you been sitting on the sidelines just taking it in, hoping to learn something, or a combination thereof? Let me know in the comments below. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you'd like to help out the channel and get up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.